We have a number of luminaries in the industry, starting with Reggie Browne, Senior Managing Director and Head of ETF Trading at Cantor Fitz, Dave LaValle, MD and U.S. Head of SPDR ETF Capital Markets, Bibb Strench, Partner at Thompson Hine, Ananth Madhavan, Global Head of Research at BlackRock, and Dan Draper, Global Head of ETFs from Invesco ProShares. Welcome, gentlemen. So, all right, so let's start off with the big question. Is there anything to worry about in ETF land?
All right, to avoid an awkward silence, I will go first. I think the point that I've made and a number of my colleagues at BlackRock have made is that the term ETF is used in a very generic way. I think the average person in this room understands all the nuances, but I'm not clear that the retail investor typically understands the difference between an exchange-traded note, a leverage product, or a plain vanilla asset-backed ETF, which is basically a portfolio comprising of stocks or bonds. So a classification system that is based on the type of exchange-traded product and perhaps the benchmarking, I think would be a great service to the average investor. And I think that's something that would help us think through where the problems actually lie and where they don't lie, and as well as make it more clear and more transparent to investors and increase the access. So,
I think similarly along the same lines, said differently, what kind of would keep me up at night. Not only is not every ETF created equally or exchange-traded product created equally, there are now over 100 exchange-traded product issuers out there. And so the reality is that not every firm has dedicated the resources to support their product and support their client base in a similar manner. And my selfish concern, and probably a similar concern to some of the other larger issuers, is that the misstep of a smaller, less capitalized exchange-traded product issuer, despite having no issue with the actual product structure, can call into question the broader ecosystem or the broader asset management industry that's behind the ETF or exchange-traded product landscape.
If I could just add too, I think the patchwork of regulatory oversight that we have, not only here in the U.S. but also globally, you had a huge movement after the credit crisis in 2008 to bring in this idea of macroprudential risk, which I think were targeted primarily at banks, to some degree insurance companies, but have worked their way into fiduciary-led asset management, which has caused confusion on a global basis. But then if you look as well, coordinating SEC, CFTC, Department of Labor for retirement, a whole patchwork even within the U.S., I think, of getting alignment around the classification system and really focusing on this fast-growing area, but doing it, I think, in a more responsible way that as content and the investment strategies change within the ETF, that they're regulated appropriately.
So let me put you on the spot. How would you fix that regulatory mess?
Well, I think we've been attempting to obviously do that. I think especially since the flash crash we had a couple of years ago. I know, Reggie, you're intimately involved, kind of working through that. But I think we continue to put forward proposals. I think as well in areas, certain regulatory bodies, I think just getting individuals in seats is probably a good place to be and getting kind of policy discussed in the right way. But in some ways, I think we're pushing the agenda within the ETF industry, but hopefully going to be in a place where other bodies on the regulatory side are going to be able to respond, I think, appropriately. But Reggie, do you want to add?
I was going to say that ETFs on a high volume day is about 40% of the dollar volume on various U.S. exchanges. And ETF governance and regulation needs to be holistically wrapped around equity rules viewed for the output of what ETFs may do and the behavior that encompass that. And I was going to say earlier, I think the barrier to entry to bring an ETF to market is too low. And I think the cost of failure is not high enough. So there should be a self-cleansing mechanism in the industry that, I know BlackRock and others have talked about classifying certain exchange-traded products so that it's a clear definition of behavior and how they're governed. But I think education, although there's a great effort to educate the individual investor, education, still hasn't reached in certain quadrants, so that there's still work to be done around governing the behavior and views of ETFs.
And maybe I would add that I worry about the regulator, because the regulator, my former division, investment management, it's their job to worry. And I think, for example, the ETF rule was proposed 9 years ago. It hasn't been adopted. There are some products out there, for example, non-transparency, actively managed ETFs that the SEC has struggled with. But you've heard today all the technology, all the innovation. There's going to be a torrent of changes coming. And I worry, I think the SEC is probably going to, maybe they've already started to reach outside and pull in expertise in the technology area to try to catch up, not stay in front, just to catch up in this area.
So speaking of technology, in the last panel we heard a lot about artificial intelligence and machine learning and how it's going to be a totally different game. So what impact do you think that machine learning and artificial intelligence and financial technology is going to have on the ETF space?
Well, my active colleagues at BlackRock have spent a lot of time over many years looking at techniques like textual analysis, natural language processing, machine learning, and so on. We've learned a lot in that process, and I think obviously on the index side of the business, there's a potentially large application for more systematic rule-based strategies. I think on the robo or digital advising side of things, there's an exciting opportunity. For example, perhaps an investor checks their statement only when the market is down, or they log into their account only when the market is down, and maybe that can be tailored to send them advice saying stay the course, et cetera, et cetera. Or maybe there's some other patterns. For example, maybe the digital advisor learns that somebody's recently moved from New York to California and still holds New York muni bonds. Time for a change. And so I think there's a lot we can learn about patterns of behavior, which are not evident from people just sitting around looking at the data. You pull it together, you understand the confluence of factors, and that can lead to better investment decisions over the long run. So I think that's where I really see the application of the AI techniques.
If I could just
Go ahead. Well, I was just going to say, I think one of the big challenges is that ultimately, well, you know that Labor proposed and they've been active part of a fiduciary rule. The SEC is talking about that. And when you think fiduciary, if you go all the way back, it's an orphan and some adult taking care of them. And a robo-advisor, artificial intelligence, can be farther from that extreme. So I think that's an example of where the SEC and even states are going to have to wrestle with. We can't push the fiduciary duty totally over to the side to facilitate the robo-advice. There's going to have to be some meeting somewhere where there's still somehow a fiduciary overlooking an investor, but that's not sacrificing all this great technology out there.
Yeah, I was just going to add, I think in agreement with all that, but I think if you look back since really the early to mid-1970s, when you had big market frictions, we had fixed dollar trading commissions really into 75 or something around that time period. So we've really seen the market frictions and markets becoming cheaper, more efficient, and that kind of leads today where we're really seeing the digital revolution creating an opportunity for mass customization at an individual level. And so I think if you're the end customer, the ability to understand what your goals, objectives, what you're trying to achieve, and having really in your favor extremely low cost, very liquid investments like ETFs, and even the rebalancing frequency. And if there's something that changes in your life or your goals you're trying to achieve, you're going to see much less friction in trying to meet those types of goals. So I think being responsible, you've seen moving from the prudent man rule originally to the prudent investor rule, incorporating diversification. Sounds like maybe we're going to evolve from prudent investor to a digital version of that somehow, where not only diversification, but additionally responsibility around personal information and all of that. But on the one hand, it's an exciting time, but as I think the previous panel said as well, cybersecurity risks and others are kind of threats to that. But there's no doubt we're moving to mass customization at really small investment amounts.
I think it comes from the ETF being an exceedingly transparent tool that's a building block for portfolios, and the growth of utilization of model portfolios at wealth management, institutions, and also self-directed portfolios has allowed the investor to really track their own performance and their alpha generation. So I think we quickly rush to, the growth of robos. Well, yes, the growth of robo is happening for a direct consumer investment, but those model portfolios and delivering of transparent building blocks to track their performance and individual portfolio performance is something that is relatively new in the context of comparing it to an active manager. And so I think that that opportunity will allow for a leveling of the playing field for performance-driven analytics and alpha generation, alpha performance to be more easily tracked by individual investors, and that will level the playing field between
Yeah, I mean,
one
to
portfolio and another.
that point, I would add that in our view, sort of the shorthand between active and or in the index and active investing is very useful. It's a useful shorthand, but it's a gross simplification of reality. There's a continuum of investment strategies, and the use of these techniques. I'm not a huge fan of artificial intelligence as a phrase, but the use of all of these modern techniques would allow us to slide that scale, and offer some of the more sophisticated investment strategies, again, in the wrapper of the ETF at low cost to individuals who'd benefit. And again, there might be a very large benefit in terms of the asset allocation. So if I think about an investor who puts their money into the S&P 500, that is actually a very active decision. It's large cap, it's US only, and it's equities. That's actually a very, very sizable active bet. And so how does the individual manage that bet along with other bets? The robos may think through all of this in factor space. So that's I think a taste of where we're going to go in maybe 10 years.
I was going to add to that view. I agree that the blockchain and AI is bringing closer to deepening client engagement and then letting investors have the individual choice. But another area, I believe, application is going to be in the clearing process. And particularly, look at Europe, for example. You have many different countries, different clearing processes. And once applied, we can harmonize globally how securities are transferred and settled. And given that ETFs are transparent, the transparency has brought a new class of investor into the marketplace. And so the key thing about ETFs is transparency. But with blockchain, I think it will bring the clearing process closer to investors getting their money doing transactions.
I heard the word blockchain. So this brings up the whole issue of cryptocurrencies. And there are proposals out there that have recently been withdrawn from the SEC to have an ETF that is based on a cryptocurrency. So, gentlemen, what do you think of the idea of cryptocurrencies in general and cryptocurrencies in ETFs?
I'll take that.
Reggie with a long-standing, strong opinion on
Yeah,
the
I mean,
topic.
I came out in 2012 publicly saying that a Bitcoin ETF is not ready for prime time, and my thesis on that
Hang on, I think you said it would never happen.
I did say it would never happen, and so far I'm correct.
For the record.
Not in the United States, perhaps other places. But you have the underlying entity that has no governance, can't be regulated, and an ETF structure can't force an instrument or a asset class to behave differently. So I think you have problems around suitability. And then we talked about classification. I think the wrong asset class or the wrong investment idea, if it were to have a major catastrophe, could harm the rest of the industry. So I think it's more self-cleansing here. So there are proponents, folks who have a large inventory of Bitcoin, who wanted to have a wrapper to provide a mechanism to liquefy their assets. I think that's the wrong move. And there's a bunch of folks who have been working on a Bitcoin ETF for 5 or 6 years, if not longer. I applaud their efforts, and I applaud the commission to see through some of their attempts, but it's not good for America.
I would add that it's not RIP, rest in peace for the crypto ETF. I mean, there were several in registration, and under the registration rules, there's an automatic effective date, and you might have seen where the SEC had those registrants withdraw them. I think one thing that's interesting we heard earlier about crypto offerings, the 33 Act, but right now they're direct offerings of cryptocurrency. There's a real question as to whether that is an issuance of a security. So, one unintended consequence, when you say no as a regulator, you push it somewhere else. You push it away from a market, price discovery, and you've got all these little small issuers of cryptocurrency out there. So they're going to be, to me, publicly offered, and then the question is, at some point, will a market or something develop where they can be pooled and be exposed to a market?
So I think there's two pieces to this from my perspective. Whether or not an ETF can be created on any underlying instrument is based upon a very simple premise. Is there the opportunity for the SEC and other regulators to confirm the fact that market participants and other authorized participants can engage in the underlying security in a way that the intrinsic value of the ETF or the fair value of the ETF on an intraday basis can be tied closely to the secondary market pricing of it? And if in fact that is the case, then it could be a suitable instrument to be brought in the form of an ETF. That's ultimately the crux of the issue. But I do disagree a little bit with what Reggie said more broadly, not about whether it's good or bad for America. I don't have that perspective, but good. He's looking for a quote, I think. What I would say is that there are great examples of a particular asset class being brought in the form of an ETF that brought a greater ability for a broader base of investors to be able to engage in that investment with a higher degree of confidence. I think gold is a great example. Physically backed ETF for gold. Look, going to 47th Street in New York City and buying physical gold was one way to invest in that. I think there's a greater application now in the form of an ETF, and I think fixed income ETFs are a great example of having a broader range of investors being able to access or exchange risk in a less liquid underlying asset classes is good examples. I'm not saying that cryptocurrencies are ready for an ETF wrapper. I'm just saying those are the two things that I think underpin whether or not it should be.
So now we're talking about ETFs in less liquid asset classes. Now, there's been a lot of concern about what's going to happen in a time of market stress when people go to sell liquid ETFs on illiquid assets. Is this a problem?
Hold on, I'll jump there. Most academics and a lot of journalists miss the fact that ETFs. Yeah, there's a paper or two I disagree with you, Dr. Angel. The ETF community has delivered 27 years of empirical evidence through all weather markets how ETF structure behaves. And if you look at market closes like Greece, the country of India, Vietnam, the ETF structure actually added transparency and risk transfer when those markets were closed. And so the question is capacity of the underlying asset class. Is the capacity allow for individual investors to pile in? So if you look at gold, when gold came out, it unlocked the ability to get exposure in an investment vehicle that beforehand the asset class was closed off to specialized dealers. So the conversation around indexing and capacity and is ETF or passive investing largely distorting smaller markets? I mean, that's debatable based on the asset class you're talking about in the country, but by large, the ETF structure has allowed transparency and a clean transfer of risk.
Yeah, and I'll add to Reggie's comments. We've seen the ETF structure tested again and again in various times of stress. In the financial crisis, ETFs performed just fine. In the taper tantrum, bond ETFs saw a surge in volume in trading. Keep in mind that the liquidity of an ETF comes from the primary market, the trading the underlying stocks or bonds, and then the secondary market where ownership of the ETF is exchanged among different parties is an additional secondary layer of liquidity, and that is always additive. The ETF is at least as liquid as the underlying asset it holds in the case of a physically backed ETF. Again, the importance of having that classification scheme. So I'm not talking about Bitcoin ETFs here, I'm talking about plain vanilla traditional ETFs. But this additional layer of secondary market liquidity is a safety valve. And we've seen that the ETF, to Reggie's point, leads in terms of price discovery. Greece is a great example, and the Athens market was shut for weeks in the Greek financial crisis. Yet there was price discovery in the ETF market. And the secondary layer of liquidity allows the offset of risk. And we've seen after these protracted closures of the underlying markets that the markets reopen almost exactly where the ETF seemed to indicate based on last trading prices. Yesterday, Veterans Day, bond market holiday. Okay, the underlying bond markets, all the corporate bonds in the U.S. Not trading, and yet you see bond ETFs exchanged for very small bid offer spreads, tons of volume, trading completely openly and being a source of price discovery. To Jim's question about is it a problem if the underlying is very liquid, you've got a perfect example of the entire market is shut down for a holiday, and yet the bond market ETFs perform just fine.
It's a notion of continuous pricing. It happens every day in the afternoon when you have an ETF that has European underliers, right? European markets are closed for essentially the second half of the U.S. Trading hours. Yet, the continuous pricing of the ETF with a transparent understanding of what the fair value is, despite those underlying securities not trading actively during the full U.S. trading hours, there's good proxies, and firms like Cantor and other market makers are quite sophisticated at managing the risk and allowing for risk transfer to happen in the secondary market with a high degree of transparency, executable quotes, and a high degree of confidence. So we believe that notion of continuous pricing and transparency is extremely valuable for the end investor.
And I'll add on the regulatory front. I'm the only attorney up here, so if you're wondering why this guy's out of sync with the group here. But they'll talk about it more in the next panel, I'm sure. The Liquidity Risk Management Program rule is going to require board oversight, and that just means a lot more scrutiny on the portfolio holdings of every ETF. So that's a very micro look, not necessarily macro if something happens. And in combination with that, and that rule kicks in at the end of next year for most ETFs, as well as a new data reporting scheme called Import, where all the ETFs are going to have to funnel lots of information about their positions and portfolios to the SEC. So this is an area where the SEC did kind of take the lead on, and in theory, I don't think it's going to stop a macro event, but it may prevent the micro type events we were talking about earlier with the small ETF.
And by the way, to your governance question earlier, and Dan touched on it just a bit. Forget about what needs to be done in the future. So much has happened in the past couple of years in terms of elevating the profile of ETFs and the broader conversation of equity market structure. As Reggie mentioned, such a large percentage on dollar volume of the U.S. equity markets is based on ETFs. I mean, we can look at the U.S. election, we can look at Brexit. Those are two shining examples of pre-market indications of down 4, 5, 6, 7%, but having smooth openings in the equity markets. Frankly, the ETF community came together, and that was issuers, that was market makers, that was exchanges. Those were taking liquidity as well from the system, came together and said we need to be better. We need to be harmonized. We need to make sure that our investors can buy and sell these products with a high degree of confidence, and the best way to achieve that confidence is to make sure that market participants are able to engage in providing liquidity with a high degree of confidence. And that really pushed, it's a strong message to the regulators that allowed to have a very strong conversation with the equity exchanges to get to a place where the transparency on the opening was enhanced significantly. And it allows our investors to, again, buy and sell these products with a high degree of confidence and doesn't leave firms like Reggie nakedly providing liquidity. So it's good.
Well, look, I think professional investors and market participants are smart enough to understand nuances around trading environments. we need to safeguard mom and pop retail who are using ETFs for their investment purposes or their retirement purposes. And so this comes back down to the question around classification and governance. If mom and pop retail have gotten the best experience in US equity markets in this current time, the cheapest execution field, and the advent of Reg MS and the various degrees around that, ETFs have played a large part around transparency. It really comes down to how to protect mom and pop during system-wide market events that occur overseas that come to the United States, and you have rules on US exchanges that hamper the transparent view of risk-taking.
So what kind of rules hamper that transparent view?
Well, there was much talk around a couple years ago around limit up, limit down, and some nuanced rules around the New York Stock Exchange and how markets open. That's been well discussed. I think that regulators and exchanges responded quickly, record speed actually, to address those rules. So it really comes down to, again, education and harmonizing how retail folks through financial advisors enter the market. You'll be surprised of the number of wirehouse platforms who don't have order types that allow the best behavior using equities, where they only choose to buy at market or sell at market. And there's other order types like stop loss market orders that should be banned. I think they are by and large. So it really comes down to market access and ability to govern best practices through all market participants, and it's still lumpy in certain quadrants.
Now, we've talked about times of market disruption. August 24th, 2015 was one of those times, and several ETFs that were based not on illiquid securities, but on highly liquid US equities, traded at prices significantly different from the underlying values. What changes have we made since then, or what changes should we be making, if any, to protect mom and pop investors going forward?
So to start, there were a number of cash equities that had significant dislocations as well on that day. This was not an ETF issue, to be really clear. This was an equity market structure issue that ETFs were a participant of.
But maybe Dave, just start to remember, futures were limited down first, right?
Sure.
So tie
no,
that in,
no, absolutely. And this was an issue of a broad market dislocation starting in Asia that kind of rolled over into Europe and then came to a unique set of circumstances in the U.S. markets where the futures were limit down. Price discovery was significantly hampered, and I think everyone, certainly market participants, had become accustomed to kind of instantaneous price discovery and instantaneous liquidity formation. And we went from computer time to human time very quickly, and that was extremely difficult for the market to manage. Keep in mind, ETFs and the vast majority of equity securities in the U.S. markets open instantaneously at 9:30. Several securities on the floor of the New York Stock Exchange took some time to find their clearing price on the open. That's an objective statement. That's not to say that one market structure is better than the other, but the reality is there was a lack of transparency as to where those securities were opening. And we didn't have the cash open until 9:57. That is, that all of the constituents of the S&P 500 had not opened until 9:57, meaning the cash value of the overall benchmark of the market, being the S&P 500, was not known to the marketplace. Now, there were some ETFs that were acting as price discovery vehicle, but overall price discovery was hampered that morning. But to use real time, I'll obviously give other people an opportunity to speak to it, but so much has changed, and we're just over 2 years from that date. Keep in mind that limit up, limit down regime, which came into the market around October of 2013, was the response to the flash crash in 2010, right? So May 6, 2010 to October of 2013, over 3.5 years. We're not even 2 years later, and we can talk about several changes to market structure that have enhanced transparency and put resiliency into the marketplace. Some are at the exchange levels with individual rules at NYSE in terms of transparency on their opening pricing for their auction-based equities. And then also industry-wide changes through limit up, limit down regime, where the SEC was pretty prescriptive in telling the exchanges to get together, and MSAC was advocating for exchanges to get together to make the markets more resilient together. So we've come a long way. There's obviously still more room to go, and that should be, with some other amendments to the limit up, limit down regime, but I'll let others talk to it.
No, I think that was a pretty thorough explanation. I'll take the higher view. I think it illustrates the need for harmonization across regulatory bodies. Look at CFTC, look at SEC, look at FINRA. There needs to be harmonization there. And the time to do it was through Dodd-Frank, and that time came and passed. I don't think there's political will to readdress that, although the Treasury had said something recently in their document last Friday. But it comes down to plan governance and then having industry represented on those plans to press views and talk about operational risk real time. So it's just times for a holistic change in how we govern US markets across product types. And so it illustrates that markets are interlinked. So you look at options, futures, equity markets, and even debt markets. So, go back to ETF world. I've been trading ETFs for nearly 25 years. So I've had the view of seeing from behavior of the Amex, New York Stock Exchange through open outcry to now electronic delivery. We're changing rapidly, and we need to change our governance as quick as innovations come into the marketplace. And the problem is that regulators and industry only act on empirical evidence and data. And so it's very difficult to react on a dime. You need an occurrence to understand what worked well, what didn't work well, and how to change. And unfortunately, you need to have some harm for that to occur. That's how we govern our markets.
Now, you mentioned changes are needed. Can you give us some more detail on what specific changes you'd like to see? I mean, if you ran the zoo, what changes would you make in the ETP landscape? What changes would you make in the regulation?
Well, I'll start there, not to dominate the panel, but being an authorized participant, through my career, I probably launched about 700 different ETFs. So this is small.
700, you said?
Yeah, about 700. Yeah. Don't need the illustration.
No, it sounded like you said 7 or 8 to me, so I want to make
Two or
sure
three.
Clear.
But even when ProShares launched the senior loan index, they were first to do it. They came to an AP and said, let's quantify the liquidity of the index. But if you look at capital formation of small companies, typically ETF starts out with $2.5, $3 million. That's a small company. And you need an ecosystem to help grow small companies across the board. So we talk about holistic view. I think the panel with the exchanges, although they were talking about shareholder value, some of it in the background, you need to create a market system that looks at every classification of equity based on market cap, and then how best to bring liquidity and capital formation with a lot of transparency around it for growth. So those are the biggest themes. How we get there, there's a lot of discussions around that. But ETFs lead the discussion through transparency and capital formation in my period. You guys can add to that.
I'll amplify on Reggie's views, which I agree with. I mean, I think I'd mentioned earlier the need for a sensible classification scheme that works for the retail investor or for the average investor that, doesn't attend seminars like this and may mix up these different products. And I think that really would be meaningful and would move the discussion along. And to Reggie's point about capital formation, once we've identified sort of the main types of ETFs and distinguished among them, so there are things that are not ETFs at all, like exchange-traded notes, which are basically unsecured debt instruments. Once we've actually classified them, then the regulators can focus on the areas where I think they do need to focus. And the vast majority of plain vanilla traditional ETFs, which are just portfolios backed by stocks and bonds, aren't a source of concern because, the creation and redemption of those funds takes place through an in-kinding mechanism. You're basically just wrapping up the stocks and bonds. People want the individual stocks and bonds back. You just unzip the wrapper and you hand them back the underlying stocks and bonds. That lets the regulators, I think, focus on the instruments that do need a lot of attention. For example, cryptocurrency type of ETFs.
Yeah, well, the timing might be ripe, because the SEC has just gone through a lot of rulemaking with Sarbanes-Oxley, and I think the SEC's cranked out a lot of rules recently. I remember at one point when I was there, we had a new director, and she said to the staff, everybody write 3 things down on a piece of paper. It sounds kind of silly. And it led to the study about the whole regulation of investment management. And with, I think, the ETF, what's so interesting from a regulatory point of view, it's straddled trading and markets in a division of investment management. So even within the SEC, it doesn't have a single regulator. So this may be an opportunity for the SEC to put together some kind of study on this product, so since it's so critical, and then obviously invite the industry in.
Sorry, go ahead, Dan.
No, I was just going to say, it's not going to change, but 1940 Act, right? And one of the fastest growing products is as a result of exemptive relief. That just tells you. Compare it to UCITS directive in Europe, for example, a more modern directive. It's much higher international take-up, obviously globally, and inclusion of derivatives of more modern structures. And trust me, UCITS is not perfect by any means, but as a comparison, if you were going to build a regulatory structure today for ETFs, it would look, I think, a lot different.
I think trying to avoid the case-by-case approval would streamline things quite a bit. I mean, Reggie launched 700 ETFs, so that's a lot of ETFs to go through an exemptive relief process. So again, I think we just want to have the focus on the things that require attention.
I think going from a little bit of a different angle, I think that while the SEC has done a good job of tackling issues of equity market structure through MSAC, and while MSAC has done a good job of including a broader range of market participants in their advisory committees, and many of us have participated on those, the reality is that those that are the closest and most aligned with the end investor need to be a greater part in a larger force in those conversations. No disrespect to Reggie, but frankly, there's a commercial interest in some of the participants that are sitting on that panel. And so when we say we're aligned with the client, the reality is we don't care what broker you use, we don't care what exchange your order goes to, we don't care what order type you use or what routing strategy you use. We want our clients to be able to buy and sell these products with again, a high degree of confidence. And so I do applaud some of the murmurs that we hear about a fixed income advisory, market structure advisory committee. I think that fixed income ETFs have largely been a great spotlight on the fixed income market more holistically, with kind of a cross-section of 2 market structures coming together and allowing investors to have a great experience in kind of investing in a broad range of fixed income instruments through the ETF wrapper. And I just think that having more members of the asset management community and the ETF community to be part of those conversations will I think, be enlightening and bring a good perspective of the investor to the conversation.
I agree.
Now, one of the issues that is sometimes raised is that some claim that at what point will we have too much so-called passive investment? That will the ETFs be wagging the dog, so to speak?
Okay, let me take that. With some co-authors at BlackRock, we've recently published a viewpoint on just this topic, and we started with the premise that the right way to sort of consider this question about indexing is not to look at the amount in index funds, including ETFs, versus the amount in active funds. That's an easy comparison to do because the data is readily available. But I think the more interesting question is, what fraction of the market value of stocks and bonds is indexed? And we did a lot of computations. We included index funds, we included ETFs and institutional indexing, and we reckon it's about a little over 10% of the total market cap of stocks and bonds is indexed in some form or the other. But even that's not really the right question, because index assets turn over at a rate probably one-tenth of that of active assets. Active managers have much higher turnover than index managers. So those assets that are actively managed are also turning over at a much higher rate. Will we get to the point where indexing is distorting the markets? I don't think so, because if indexing ever does create temporary price pressure, transitory price movements, those are simply opportunities for active managers. You would love to be the last hedge fund standing if the world is 99.999% index, because you would actually profit from any adds and deletions that are published in advance that everybody else would mechanically buy. So we will reach an equilibrium where the active investors are rewarded and active managers are rewarded through their fees, and similarly with index investors.
If I could add, I mean, I just don't like the question. So for me, the question I like better is to what degree does security selection matter versus asset allocation? Because that's really what we're talking about here. And I think we've seen through, and that question alone is going to be dependent on market conditions, a lot of macro variables. But I think what we have seen is more efficient for the average customer who've been over-reliant for decades on security selection, and now looking at top-down asset allocation vehicles at an affordable price where, whatever academic study you want to look at, the importance of asset allocation, is really, really important. So that incremental, as you mentioned, that incremental, active manager who's focused on intrinsic value around security selection, where does that matter? And that's a real value to society, right? And ultimately, I think that getting that balance right, I don't think it's prescriptive, but I do think we have seen an enormous shift to ETFs and indexing funds simply reallocating to more efficient asset allocation around end goals and kind of end solutions that particular investor group or investors are trying to achieve.
Yeah, and I think it's also important to understand in terms of the continuum of investing styles that I talked about, that many active investors are users of ETFs. They use ETFs to get, to equitize cash. They use ETFs for asset allocation decisions, to lay on bets about countries, about sectors, industries, et cetera. So the notion that somehow ETFs don't contribute to price discovery, I think, is also, misconceived. I think all of that trading is in some sense a contributor to the price discovery process, which is so important for capital formation. Getting back to Reggie's points.
But I agree with everything that you're saying, but let's even push it a step further and assume for the fact, because I think oftentimes when people say passive, they automatically jump that's ETFs, right? So let's actually dive into ETFs and talk about the reality of what's happening behind an ETF trade. By and large, and some quite sophisticated investors we face off with institutions all the time assume that every ETF trade results in the trade in the underlying constituents, which is just not the case, right? So the idea...
That's the secondary market layer of liquidity I was talking about.
So when I buy an ETF from Reggie, because he bought it 3 weeks ago on his personal account and he's happy with the profit and he's selling it, he walks away and I want to buy it because I think it's going to go higher. There's no trading of the underlying securities there. And the reality is there's a ratio between kind of dollar volume in the secondary market in the form of the ETF and then the dollar volume in the underlying constituents. And that ratio can fluctuate, and it's dependent upon the product and it's dependent upon the asset class. But oftentimes people think it's a 1-to-1 ratio, and it just isn't. And so even if we were to say that ETFs are passive and we were to look into the ETF, which obviously is not the case, and I agree with my fellow panelists here, the reality is that that ratio can be as high as 25-to-1, where $25 dollars are trading in the secondary market in the form of the ETFs as to every dollar in the underlying constituents. And so the tail just isn't wagging.
The other thing I can just add, so you heard, I think Adina was very articulate in the earlier panel. At the same time that you have the growth of passive or index investments, I would argue you've never had a better time for activist shareholders to come in, proxy access, everything that kind of Dina was mentioning. So I think ironically, the ability from an intrinsic value and valuing individual companies, securities, having a control over operations, financial decisions, all of that, ironically has never been greater at the same time. So I think if you are someone who can understand, obviously with scale as an activist in many ways, to influence individual securities, that's becoming, I think, more efficient and more prevalent for operators who can do that well. At the same time, passive's growing.
I wonder, though, one thing, there's a slight distortion. Again, a lot of it's regulatory driven. With the smart beta ETFs, they're probably categorized as passive, but because of the inability to get an ETF order for an actively managed non-transparent, you're seeing more and more, partly because of that, you're seeing more and more smart betas, which are kind of almost hidden, actively managed. And I guess the other part too is, you have a lot of active managers out there because of this issue that are unable to use what many people think is a superior product to offer. And whether, if we clear this hurdle, whether overall the ecosystem's healthier by inviting actively managed ETFs, and so we don't have this stark, passive, actively managed.
If I could just add, I think that where it seems that the smart beta or equivalent terms are kind of moving is that you really are looking at active asset allocation, right? And then I think the question is, and you have active, transparent ETFs today. So that ability to not have to disclose holdings and front run and all those big worries, because those are actively through an active rebalance strategy or through factors or some other weighting system, they're going after asset allocation in a very active way. I think the question is, for those security selection experts, are you able to then provide them a vehicle where they can protect the integrity of their security selection process, but still let them use the vehicle? And I think ultimately, if you do, but still that weighting between asset allocation and security selection, I still think you're going to have overwhelming demand, really more in the asset allocation arena than you would security selection.
The great equalizer will be your return.
Right.
Now, let's now gaze into the future. When we come back 5 years from now for the 8th annual Financial Market Quality Conference, how will the ETF landscape have changed? And what other changes do you see taking place in the future?
So, the author and futurist William Gibson has this great quote, which I like, which is, he says, the future is already here. It's just not evenly distributed. And, I flew in from San Francisco yesterday. We have self-driving cars that occasionally go near my place of work. And, that's very different from some other places where you would not see that. And so I think the future is already here. It's just not particularly evident. So I'd say, bond ETFs are where I see the biggest growth. Bond ETFs trade like equities. So yesterday on the bond market holiday, Columbus Day, they were trading penny-wide. The larger ones were trading penny-wide, fully transparent. You know exactly what's in the portfolio. Maybe the 1,100 constituents, 1,200 constituents, and some of the big ones. You have pre-trade transparency. You see bid and offer quotes that are actionable. You have post-trade reporting. There is really no difference than an equity, and that transformation of the ETF, into this asset class where indexing and notions of cap weighting are less well understood than equities is actually really transformative. It's going to transform the fixed income markets, the underlying markets, which are still largely opaque and over the counter and high cost. And this is going to lead the way. So I think that's where I'll sort of say that, in 5 years when we come back, and hopefully I'll be invited back, and we'll talk about the assets in the bond market, and we'll talk about the knock-on effects for bond market structure. I think it's going to be huge. So,
Reggie will be short the Bitcoin ETF that I bought from him. So he'll be here, and I'll be on my boat. No, I'm just...
You hope.
No, kidding aside, obviously. I think the reality is, piggybacking on that concept, we're going to see that a larger portion of the fixed income markets are going to be represented in the form of ETFs. I think oftentimes when we ask, again, highly sophisticated members of our investment community how large the fixed income ETF asset base is, typically they come somewhere in the neighborhood of 5 to 15%. We haven't yet eclipsed 2% market share. We have eclipsed 10% market share in trading volume, especially when you start talking about high yield exposure. And so I think that the reality of the benefit of that risk transfer in the form of a high yield ETF is going to result in more individual investors and more institutions utilizing the ETF wrapper, to realize that investment. Additionally, I think oftentimes we talk about ETFs versus mutual funds, and I think that's actually a pretty narrow view. I think it's kind of ETF versus exposure, right? Whether it's futures or other derivative products that are less transparent, more opaque, more difficult to price. I think that oftentimes I use the analogy that 15 years ago, you would never understand the concept of Uber because we didn't have smartphones and GPS, right? So I think that ETFs are that disruptive technology, and we haven't figured out the Uber utilization yet. So I think that we don't know what we're going to have in 5 years.
I think the theme 5 years will be the global growth of ETFs in new markets. Canada, Australia, Japan. There are rules that are in place that mimic DOL in the United States. That's going to cause growth, particularly in those countries. And so if you look at the global adoption of new rules, it's been around transparency of fees and prices and best practices for retail investors globally. So I think the ETF sponsors will pivot pretty hard into Europe. They'll continue to look at Canada around CRM2. They'll look at Australia around future of financial advice and the governance around futures and swaps. And if you look at the adopters of ETFs in the United States, the new adopters are institutional. It's going to be insurance companies and asset managers. So I think there's going to be a groundswell around repricing and groundswell around regulatory behavior for consumers around best practices.
I'm going to go way out there. And maybe it's not 5 years, maybe it's 10 years, but blockchain, I think when everybody has their own ledger and everybody else has their own ledger, and then we're trying to anticipate what millennials and even younger are going to do, which is, I don't think anybody knows that. In theory, you're going to be able to interact with another person, another entity directly. And as simple as a new CD coming out by the Chainsmokers, you're going to have the ability to wager on that. Instead of the Chainsmokers waiting for royalty, they're going to put it out there. If you want to invest in my album, take a risk. And I throw out that example just to say there's kind of an unknown, but I think probably maybe the biggest growth will be exchange-traded products, which again, we don't have a classification system, but I kind of put those as non-ETP securities products, any other assets. And you're already seeing cryptocurrency potentially. There's going to be more and more of these different unique assets out there. Will there always be a need for pooling, for diversification in some kind of an exchange where you have price discovery? So the ETP will survive for those reasons. It's just, I think, trying to predict what young people are going to invest their savings in right now, 10 years down the road, is pretty tough.
Because if I can just take it from an issuer's perspective, I think Reggie hit a point early on from an issuer's perspective that ETFs have a very low barrier to entry, a very high barrier to success. And I think if you look at the numbers, 99% of all the global AUM in ETFs, $4.5 trillion or somewhere around that, 99% today is attributable to issuers who were in the market in 2010 or before. All right, over the past 12 months. You look at the net inflows into this industry, 96% of the net inflows prior 12 months are attributable to issuers who were in the market 2010 or before. And you can also look in that same pool of global assets that over 70% of that AUM can be attributable to the first strategy, or asset class in that ETF category. So I think we're seeing the future today really from an issuer perspective. And you're going to have continued growth, consolidation, but size and scale, ultimately really matter. And I think that's where also being able to bring, if I can use the example of Netflix, for example, where you can separate the content value versus the delivery mechanism. And clearly being able to use third-party index content has been ruled the roost, like Netflix started. But also Netflix really got off the ground once it built its own content and be able to control and understand. So I think in 5 years, you're going to see the real value chain appreciating, probably moving to that unique investment content and having some ownership and being able to maintain margins, if you will, there at all the time providing value to shareholders. And then you see the structure, the trading, the delivery mechanism becoming more and more commoditized. Whether it's our equivalent of streaming or you have it through the cable in your house, that transmission vehicle is going to be more and more commoditized.
I also think it's a little bit narrow focus to talk about the future of ETFs without talking about the future of the overall equity markets. We're in a really unique spot right now where we're seeing some consolidation, at brokers, Virtu and KCG being kind of the most recent example of that, but you have fixed costs that are increasing for brokerage houses. That's making it more difficult for them to trade and be profitable. You've got a low volatility environment. What we're seeing episodic spikes in volatility, which is very different. And notwithstanding some geopolitical uncertainty where we could see higher sustained levels of volatility, which would be good for the profitability of market makers and others in the marketplace. The reality is to talk about where the ETF industry is going and how liquidity is formed and how price discovery is happening and how liquidity is being provided to the end investors is difficult to predict without having a better sense of what's going to happen in the broader equity markets.
And I believe we have time for one quick question before our break. Does anyone have a question?
How do you protect mom and pop investors from I'm an equity trader, been doing it for 10 years, these ETFs, which are seemingly tied to nothing. I mean, if you get in there, I love trading the UDXY or the SPXY or the USO. But how do you protect mom and pop from going out there and thinking that these vehicles are great things to invest in? I mean, with the UDXY, and if it reverse splits, it's just going to go to zero because of the volatility. I mean, what do you tell the public about that?
Somebody repeat the question.
Let's repeat the question for the microphones. How do you protect mom and pop investors from ETFs that are really unsuitable for them? That and the example is sort of some of the volatility-related ETFs that may go to zero when they reverse split. So how do we protect Mr. and Mrs. 401k?
Well, start with the classification scheme, because I think there were a lot of people who bought ETNs. There were some Lehman ETNs, and they became unwitting creditors of Lehman in the bankruptcy. So I think you start there.
I mean, how do you stop those same clients from going to Las Vegas and having a big old weekend and losing everything, right? And I think this is really where our job as fiduciaries and everything that we do, and in particular, I think if you look at the ETF, not ETP, but ETF itself, which is an open-ended collective vehicle where there are assets backing this investment with a custodian, right? Now, again, there can be some short and leverage products, which I would move to the side, but over 99% of the industry, and this is very different. When you're looking for bubbles or problems, normally that's associated with some form of leverage, right? And I think for the most part, this industry, again, taking the minority short and leverage products out of the equation, these are collective vehicles, I think, with secured assets. So then you have to make sure that you're diversifying the best way for that client to meet future goals. And that's where I think holistic wealth planning and even these fiduciary rules and concepts are really moving, as Reggie said, really all over the world now.
So unfortunately, we're out of time. It is break time coming up. We have a 15-minute break, so we should return at 3:30. And so, but before we break, let us give a nice round of applause to our panel.
Well done.